देख अगर वीडियो स्टार्ट कर ली तो अपना वीडियो भी
Good morning, Aditya. Good morning, Anupam. Good morning,
Hi.
everyone.
Yeah, hi, good morning. So we are welcome all participants. Aditya.
Yeah. So, a very good morning and warm welcome to everyone for this event. We always try to bring in a lot of intelligence to share. So, we always believe in sharing. And today we have Santosh with us, Santosh Malar, who will be sharing his experience, his knowledge about uh, the financial sectors. And I just give a brief introduction about Santosh. So Santosh is a chartered accountant and he has experience of over 15 years. He has been associated at a very good research angle with Big Four. And to add, he has also written 7 books in related to Indian accounting standards and financial reporting. And when we speak about COVID environment, he has also come up with a book recently that is about what are the reporting requirement and what kind of disclosures we should have in our financial reporting. But to speak more on it, I'll hand it over to Santosh, who can speak more about it, more on his work, because it's always better to hear it from the person who has written it. So, hi Santosh, I just hand it over to you, and yeah.
Yeah, hi, Aditya. Thank you for the kind introduction, and very good morning to all of you. The topic for the day that I was given is basically financial results. So, friends, as we know, in COVID-19, these are highly uncertain times. And we have seen the March results, the June results, and September results of companies, of listed companies. And majority of them, if not all of them, have had some mention or the other about COVID-19. So what we thought, Manoj ji and myself, we were deliberating on what topic to have for this session. And the idea that we came up with is that why not cover, why not cover how companies are reporting the impact of COVID-19 in their financial statements or their financial results. And given that, we have seen at least 2 quarters, Q1 and Q2, ever since this pandemic broke out, we thought that we can cull out some of the notes from the listed financial statements of listed financial results of leading companies, and that can be a point of discussion. So what I've done is I have put together some slides on what are the key issues that typically a company faces, and then also we'll see extracts from financial results of listed companies. Feel free to react, or feel free to provide any inputs, or to ask questions, or if you feel that certain things are not very clear, please feel free to, let's try to make this session more interactive, because online, otherwise it becomes a very, you're just talking in front of a laptop. So you don't know what's, the level of interest, etc. So let's try to keep this very interactive, and feel free to contribute.
Yeah.
So let me just share the screen one second.
Santosh, you have been allowed to share the screen. You can do it directly yourself.
Yeah, just give me a minute.
Right. Oh.
And Santosh, where participants are really very enthusiastic, and they do ask a lot of questions. So you will
Great. Look forward to.
Yeah.
Look forward to. Okay. So, is the presentation visible on screen?
Yes, we can see that.
All right, great. So, firstly, a bit of, a quick refresher on Ind AS. So I was told that, not everyone would be very well versed with this. So just for the benefit of some of, those of us who are not very well versed with the transition, the phases of Ind AS. So Ind AS, as we all know, is the IFRS converged accounting standards that we in India have been, applying since financial year 16-17. The first phase was, of course, the listed companies and, unlisted companies with net worth of less than 500 crores. 500 crores was the threshold checked for the first phase. The second year, the next year, that is FY 17-18, we saw the remaining listed companies. When I say listed companies, it covers equity listed as well as debt listed companies, and unlisted companies with net worth of more than 250 crores. And then in the financial services sector, the the NBFCs, either listed or non-listed, with net worth of more than 500 crores, they transitioned to Ind AS in 2018-19, FY 18-19. Of course, the original plan was, the heading of the right hand side of the slide is banking and financial services, but of course the banks have not yet adopted Ind AS. They were to do it originally in 18-19 and then in 19-20, but then RBI has been deferring the Ind AS implementation for banks. The major reason for that, of course, is that the expected credit loss provisioning, which is one of the main impact for financial services, and we'll see a few results of NBFCs who have applied Ind AS. ECL, or expected credit loss provisioning, is very, it's a challenging area for financial services sector. And now, especially now in the current COVID scenario, it's all the more complicates the matter. So banks have, not yet bitten the bullet of Ind AS. And then the last phase was FY 19-20, where unlisted, NBFCs and, the all NBFCs with net worth of more than 250 crores adopted Ind AS. So that's a bit about the Ind AS roadmap. One must remember that when a company applies Ind AS, or when a company is caught in the ambit of Ind AS, it doesn't get into the Ind AS solely. It also applies for the group companies. So all subsidiaries, holding companies, joint venture associates also have to transition to Ind AS, and therefore it's a group-wide transition rather than a standalone transition. As I mentioned earlier, RBI, through notification dated 22nd March 2019, deferred Ind AS implementation for banks indefinitely. And the reason that they mentioned in that notification was that the Banking Regulation Act, it was not, it had not some of the consequential amendments that one would have wanted in that act as a result of Ind AS have not been carried on. We all know that, from a financial statements perspective, there are quite a few changes, like effective interest rate or expected loan provisioning, etc. And also the presentation aspects significantly change. So in fact, in Schedule 3 in Companies Act, the schedules which give the format for balance sheets and P&L, we have a separate division 3, which only covers NBFCs. The way balance sheets are presented for Ind AS compliant NBFCs is vastly different from what we were earlier doing, because the sequence is basically based on liquidity rather than current non-current. So that makes a lot of difference from Ind AS perspective, and perhaps that's one of the reasons why RBI did not really they have deferred it indefinitely. And the larger reason, of course, is the provisioning, the loan provisioning aspect of Ind AS, which would have a significant impact on their results and their net worth. So coming to this pandemic, of course, we all now know, and most of us would have seen many articles or publications or seminars or events where COVID-19 impact has been have been discussed at length. So of course, this is a human, economic, and financial crisis, and there are various studies done by agencies like IMF or CRISIL or various other, where the outlook is very somber. I mean, the GDP projection for this year, there's a decline which has been projected for India, and it's also true for the other major economies like Europe and US. So I don't need to repeat that. This is a very uncertain time, and the outlook is very, very somber. So as a result of that, now, so that being the case, as a result of that, yeah.
Okay.
So as a result of that, there are consequential accounting implications. So as an auditor, currently in most of the clients, what we are seeing is the discussions that we are having is regarding impairment. So when we have the economic outlook, which is on a decline, and let's say we have sales decline of a company, the immediate standard which comes into play is whether there's an impairment. So if I have set up a factory and the sales are on a decline, so the immediate question that an accounting or an auditor would raise is whether there's an impairment in that particular factory. Likewise, if there have been business acquisitions, business combinations, whether the goodwill that was paid to acquire that business should be impaired. So one of the most widespread impact of COVID-19 has been that impairment studies, impairment analysis have been, that's like the flavor of the season. So otherwise, the standard requires impairment only when there are indicators of impairment. Okay, so of course, declining sales and the current environment, the economic environment is one of the factors which would warrant an impairment testing, and therefore impairment studies are like very, very widespread, and that is one of the accounting implications. We'll see some of the results where they have booked impairment losses in Q1 or in Q2. So we'll get to that. Inventory was again one of the most challenging parts of this COVID for multiple reasons. The first, the basic challenge which we as auditors faced is that March being generally the month where we auditors and the companies carry out their physical counting, the physical verification of inventory. How do you do that, given that there were travel restrictions, there were you were not able to visit to the client site or warehouses? So how do you do that? That was number one challenge. Number two was how do you estimate the net realizable value of the inventory? Inventory is carried out at cost or net realizable value, lower of the two. So if there have been declines in sales price, or let's say because of lack of movement, lack of replenishment of inventory, there have been obsolescence, or let's say the inventory has got, if it's let's say a perishable inventory, has got spoiled. So how do you measure the extent of the obsolescence or extent of damage to the inventory? And therefore the next challenge that companies had was to write down inventory. And again, we'll see some of the companies which either in March, June, or in September have written down inventory. And the other aspect to this is the oil shock which we saw. And sometime in April we saw the oil prices almost bottom out, almost to its historical low. And therefore in many sectors like oil and gas or chemicals or any inventory which has some relation with oil price, or it's a hydrocarbon, we saw companies booking NRV write-downs, net realizable write-downs, because of the overall decline in the price at that point in time. Of course, now there has been some recovery as we speak. Crude oil is hovering around $42 per barrel. So there has been some subsequent recovery in that market. The third challenge in inventory was around inventory valuation. Now, what happens is, if you're a manufacturing company, when one does inventory valuation, one loads some part of the factory depreciation of fixed overheads into inventory valuation. And what happened was, because of the lockdown, and if you have a company where the factory was not able to operate at its optimum capacity, the standard doesn't allow you to load the depreciation or the factory overheads to the inventory, simply because it's like a wasted cost. So you cannot load that part of the overheads on the inventory for the purpose of valuation, and therefore you have to expense it out. So we have seen companies for example, in steel sector or power sector, where they had a significant issue on account of inventory, the valuation having declined, and there were abnormal wastages as a result of that. So there were increases in losses. Coming to revenue, of course, for a normal company, for a normal FMCG company, the main challenges were around the logistical, because of the lockdown, some of the logistical, there were fewer drivers as compared to normal logistic companies. The cost of supply chain had significantly increased, and therefore removing goods from your factories, there was a significant delay that impacted revenue recognition. Likewise, in case of companies following what is known as percentage of completion, that is companies in engineering sector or construction sector, the way revenue is calculated is, you have the projected, you have the contract revenue. So you have the cost to completion divided by the total expected cost. Now, when your total expected cost increases as a result of, for example, because of delays or because of higher manpower cost or higher input cost, you have to actually see whether there is any onerous contract or any loss which has to be booked straight away. So those were the kind of issues around revenue that people encountered. In a very extreme cases, there were going concern issues. So generally, financial statements are prepared under on a going concern assumption. Sectors in the most, the sectors which were most susceptible to lockdowns, like hospitality, leisure, aviation, some of these sectors, some of the leading companies did have significant notes in their results around going concern. Of course, most of them did mention that the assumption still holds true, but there were significant challenges around it. So therefore, in many cases, going concern, it looked like the auditors and the company had a lot of discussions around going concern, and we'll see in subsequent slides the disclosures that those companies made. Financial instruments, the most common issue Financial instruments, the most common issue that companies are facing is that around provisioning for trade receivables or for loans for NBFCs. And, given the fact that Ind AS requires an expected credit loss provision, which means that I make provision not based on today's delinquency, but I anticipate if there will be future delinquencies or future delays in my realizations, and and based on that I make a provision for bad debts today. So because the current environment is so uncertain, and because you don't know whether there will be delays or defaults amongst your customer base, you have a lot of difficulties on actually accurately anticipating what kind of losses. Any questions?
Sorry, Santosh. We'll just request everyone to mute themselves if they are not, if they don't have any question. We are having some disturbance. Santosh, yeah, go ahead.
Yeah, and let me also pause here for a minute and invite questions if any reactions or questions. So this is like a kind of a snapshot of the impact that at least I have seen. And then subsequently for each topic, we'll see how specific examples and instance of companies.
So Santosh, I have a question. So like when we look at your bullet points, like I can see 12 bullet points there. So like, is there any kind of requirement that we need to disclose all these items in our financial statement, or any management information what is presented with the financials?
See, now what happens, there are two things. First is the annual financial statement. And we all know that the disclosures in financial statements, the annual financial statements are very, comprehensive, especially under Ind AS. So yes, all these bullet points, somewhere or the other, they will find, place in your disclosures in the annual financial statements. But when it comes to quarterly results, which are governed by the LODR, the SEBI's LODR, the disclosure requirements are only for the significant events during the year. So for example, you wouldn't expect revenue recognition issues to be discussed in the financial results. But if there have been certain, discussions around going concern or certain mitigating factors around going concern, and of course we'll see these in, some of the examples in subsequent slides. If they are so drastic, then it warrants a disclosure. So to answer your question, quarterly financial statements are much more concise as compared to annual financial statements.
Yeah, thanks.
And then we had debt covenants and debt servicing. Of course, the moratorium did, see to it that many companies did not breach their debt covenants, but some of the contract covenants, not quite debt covenants, but contract covenants, many companies ended up breaching because they were not able to meet their contractual obligation, and they had to kind of renegotiate the terms with their vendors or with their customers. Litigations on contractual defaults, as I mentioned, again, contractually, what was, let's say if there's a company, so for example, there were these oil marketing company, OMCs, the BPCL or MRPL. They had to lift minimum stock from the extraction companies internationally as well as domestically. So they were, since the demand for oil had significantly declined in April, May, June, they had to actually renegotiate the minimum offtake provision, the minimum offtake clauses in their vendor agreements, and therefore they had to renegotiate with the vendors. One of the most common theme that I have seen is exceptional items, presentation of exceptional items. So whenever there is any item which is significant in nature and not expected to occur very, frequently, there is, an option, and generally people would disclose it as an exceptional item. And if you look at the format for the financial results in SEBI's LODR, you would find an exceptional item, line item in the results. So many companies did present, exceptional items in their results and in their, financial results. Most of the exceptional items were around, for example, cost of VRS, voluntary retirement scheme for the employees, cost of, any kind of, a loss on, litigations or loss on account of impairment. So some of the impact of, as a consequence or as a result of COVID-19, most of the companies did, manage to end up classifying as exceptional item in their financial results. Accounting for, again, shutdown cost was widely, debated. Even in the institute, there were a lot of discussions on whether, shutdown costs, whether, you can have a situation where you can capitalize that. And of course, technically the answer to that is no. So you cannot capitalize shutdown costs. So even if, you have paid your employees despite of, not being, the employees not being able to work or come to office, still you cannot present it as a capitalized cost. It has to be REVEX. It has to be expensed out. Insurance claims, again, there were a lot of discussions on when do you recognize insurance claims, and the answer to that is there has to be a virtual certainty. You cannot do it based on expectations or probability. It has to be virtually certain that those claims will be honored by the insurance company. Onerous contracts. So in accounting standards, there is this concept of onerous contracts, where if you have a contract that is a binding contract, where the cost of honoring that contract exceeds the revenue or the income flowing from that contract, in that case, it's a loss-making contract, and therefore you need to make a provision straight away. You don't do it based on, as the events occur. You do you create a provision towards the future losses straight away. So for example, let's say if I have rented in stores, let's say, retail stores, and let's say if because of the lockdown, I'm not in a position to open it up because of the restrictions, the government's restrictions. So while I have the lease cost, which is there, which is, ongoing, I don't have any revenue coming from the lease contract, and therefore it will be an onerous contract. Therefore, I'll have to make a provision towards the incremental cost. And incremental cost can be not just the future leases, but if I have to wriggle out of the contract, if I have to terminate the contract or foreclose the contract, the penalty involved, I need to make a provision towards that. So onerous contract. Yet another example is, let's say if in March, if companies had booked for let's say a conference, employees, sales conference in some nice locations, and unexpectedly this pandemic broke out, and therefore since middle of March there were travel restrictions, etc. So if there were, this conference had to be, cancelled, and there was a penalty which had to be paid. So I don't wait for the actual conference date, the originally anticipated conference date to arise and then make a provision. I create a provision in book straight away, given that, I won't be able to, I'll have to cancel the conference, and the penalty payment will have to be paid. So based on that, there will be a contract, there will be an onerous contract provision. And then lastly, foreign exchange differences. So for example, export heavy companies faced a lot of foreign exchange losses because of the variation in foreign exchange. Again, which is typically in India, we see that whenever there is exceptional situation, you have a significant variation in the foreign exchange. So companies who are having significant exposure to exports or imports do face challenges of or those who have FCCBs or ECBs or foreign loans. They face this accounting challenge of foreign exchange losses being booked in their PN. So that was more like a overall kind of a summary of the impacts which we have seen in the financial statements or financial results. Uh, just wanted to open it up for discussion in case anyone has any questions or reactions.
So, Santosh, I'll just take a minute. Like there are a few joinees in the event today, so I just want to introduce for the interest of them. Santosh is giving us an understanding on the impact of COVID and the disclosure requirement which will be required. He has written 7 books on Indian accounting standard and financial reporting. We would like to felicitate him with what he has done. And for the interest of all, I'll just want to tell you these are the books you may see on available, which you can go ahead and search it out on Amazon. Maybe I have pulled out from Amazon to see these are some good interesting books which he has written. So feel free to look for these interesting books. And congratulations, heartiest congratulations to you,
so
Santosh, for your achievements.
Thank you so much.
In addition, we have surprise today to just inform everyone that we have 2 people cleared the chartered accountancy for England and Wales, ICWA. So Hardik, congratulations to Hardik and Pramod for their achievement. So for the interest of all, basically this ICWEA has come up with a pathway concept wherein a chartered accountant from India can get affiliated or can get a certificate from ICWEA, and we need to have some 6 to 7 years of experience. We have to answer 5 questions. These questions are related to your past experiences. So nothing academic is what they're expecting. These questions are basically how you manage things, how experienced you are, how you were able to identify problems in an organization. So based on your experience in last 7 years, you can just put up this write-up. It's a 5 question answers limited by some words. We just need to put up and submit it with the authority institute. And once they review this, they give you a marking and you are certified for England and Wales. So congratulations to Hardik and Pramod. In case you want to speak on anything, most welcome. Like you'll be the right person to speak about your experience. In case Hardik, are you there?
Yeah, I'm pretty much on.
Yeah.
Am I audible?
Yeah, you're audible.
Okay, no, thanks. It was certainly an interesting experience, and you put it rightly. It is an examination of experience, and they are kind of particular about what kind of experience we really have, and then kind of how we are able to translate that into a set of essay type questions and responses, set of essay types responses, that too in a concise way to express what we really want to say. Yeah, I mean, apart from me and Pramod, obviously there are other kind of ICW qualified folks on the group as well. Me and Pramod obviously just cleared it very recently, but we obviously have other distinguished on the group. So, yeah, it was certainly an interesting experience, and thanks a lot for a number of folks on this group who helped me, encouraged me in taking that up. Thank you.
Yeah. Pramod, do you have Are you there?
Hi, Pramod is joining in later.
Okay.
And I would like to congratulate Santosh, Malar and Hardik for great work done and being done by them in their careers and contributing to industry and the profession. I would also like Ajay Parmar and Yogesh Satpute, who have joined part of the think tank team, to say a few words on the achievements by Santosh, Hardik, Pramod. And there are many more people from the group and profession planning to do that England and Wales qualification and honors. And it will be really great. Ajay and Yogesh, Mitesh, you are there. Can you please say a few words in their honor?
Hi, this is Ajay. Can you hear me?
Yeah, Ajay.
Hello. Yeah. Hi. Congratulations, Santosh. I think I'm really impressed by the way you have presented the whole thing, and I'm definitely willing to take the next step to buy those books. I think accounting standard is one which we at least in my profession, I'm not very much well versed, but this will keep me always ahead of the others. And for Pramod, I think, and Hardik, my heartiest congratulations. You both are now at par with HDFC's Deepak Parekh in terms of qualifications. I think he's also the one with CA and ICAW tag. I think he's an old veteran. And I think this is like what I feel is the way, the exam is conducted. I think I believe that ICAEW is respecting what the Indian CA Institute is giving, or the studies that we are going through. So I think they consider that we are at par, maybe little ahead of them in terms of the way we work or the kind of number of hours of hard work they put. And this is an honor to all of us. I think if you get time in if you get time of say 15 days to 1 month, I'm also an ICW. I can definitely guide some people, and I think it's a good thing to learn on. There are two degrees I always refer to. Is one is the CFA and the other is the ICAW. I think any of these you can pick up. Thanks.
Great. Ajay, Yogesh, can you please join in?
Yogesh, you are on mute.
Yeah, Mitesh, please say a few words.
Sure. I was saying that Yogesh is on mute while he was talking.
That's okay. Great work by Santosh.
I was telling that I had 2 flaws. I just can't hand over it, but I can at least show it from my screen that I heartily congratulate all the successful candidates, and plus they've actually put a lot of hard work.
I joined little late and I missed the good presentation which has been made by Santosh while I was on the latter part on this. And as far as the achievers are concerned for this month, I will say the trend will go on and it's taking the pace. Congratulations to Hardik and Pramodji as well for this super achievement. And yes, the international degree has the recognition, and even I'm shortly going to get enrolled myself for ICAW.
Wonderful. Congrats, Mitesh.
Yeah.
Incidentally, Yogesh Satpute is an eminent banker who did a digital felicitation, and Mitesh Parekh is a eminent partner in a top firm.
Great. Thank you, Yogesh. Thank you, Yogesh.
Okay, thanks everyone. Santosh, all to you. You can take the charge of the presentation.
Yeah.
Apologies to take it this way.
Yeah, apologies. It took additional minutes actually from my side also.
No worries. Okay, so as we discussed, so now having seen the overall impact, now next few slides, what we'll do is,
No, you will have to start, present it again.
Sorry. Okay, so having given you all a snapshot of the accounting implications of COVID, now what we'll do is individually, standard-wise, we'll look at some of the impact that again I earlier spoke about, and also we'll see which all companies did encounter those specific impact, and then we can of course discuss and deliberate on the specific matters. So as I said, the inventory was one of the major kind of problem areas of COVID, mainly because there was many companies encountered a write down of their NRV, net realizable value, basically due to reduced movements in inventory. Now, inventory broadly, you can see that it's broadly of two nature. One is the perishable ones. So, for example, let's say food items or let's say chemicals, which would spoil by passage of time, efflux of time. So, of course, in those cases, you would lack of movement, you would have a significant impact on inventory, and you would have a significant net realizable value provision. And then in other cases, the non-perishable ones, the inventory which doesn't perish based on efflux of time, you would not have the issue that of inventories getting spoiled, but you would have issues of, let's say, sales price decline. Let's say if the prices of the finished goods are on a decline, then perhaps as AS2 or Ind AS2 requires, that you would have to reduce the inventory value because there is a decline in the net realizable value. So those were the kind of two classes of two types of issues that emerged. The second issue, as I mentioned, is the issue of loading the production overheads or fixed overheads on the inventory. So, for example, let's say if I have a factory and there is an electricity cost, or let's say there is depreciation cost of that factory, which in normal times I would load the cost on the inventory valuation and the inventory cost. But if, let's say, because of the lockdown or because of lack of labor or lack of sales, if the factory is running at suboptimal capacity, let's say at 30% or 40% of its normal capacity, in that case, I would have I cannot load the entire depreciation cost or entire electricity cost on the inventory value, simply because it's perceived in the standard as it will be a wasted cost, and therefore I can only restrict that. So supposing, let's say, if I'm only operating at 20% of the capacity, so only 20% of the fixed factory overheads I can load on the inventory. So therefore, in that case, I would have to expense out the remaining 80%, and therefore I would have significant losses on account of Ind AS2 requirements. The third impact was in case entity ceases production or significantly reduces production for a period of time, significant portion of fixed overheads will need to be expensed out. This we discussed. So accounting terms, these were the impact. Most significantly, Reliance Industries in their March results gave this note. So the extractive part of Reliance Industry, of course, it's more or less like a conglomerate today, that they are into telecom, retail, oil and gas, petrochemicals, so on and so forth. But the petrochemical part of Reliance Industry gave this note. They said that the company has determined that non-cash inventory holding losses in energy business due to dramatic drop in oil prices accompanied with unprecedented demand destruction due to COVID-19, and the same has been disclosed as exceptional item in the financial results. This is the March 20 results that I have picked up from. The impact of the same and the net current tax for the quarter and year ended 31st March 2020 is 4,245 crores. So because of the decline in oil prices globally, and because of the inventory that they were holding at that point in time, because of the net realizable value of the inventory going down, they had a provision of 4,245 crores in their March results. So that was the tune, that was the extent of the loss that they had. And of course, subsequently, now that, oil prices have partly recovered, I would expect that this would have reversed in subsequent quarters. But this was the tune, this was the extent of the impact initially in March, which Reliance had in its financial statements. And then auditing challenges, as I mentioned, because of the restrictions in travel, because of the travel restrictions, auditors were not able to go and witness the physical counting that happens, the physical stock take that companies were supposed to undertake, and many companies themselves couldn't actually count their stock, and therefore there was an issue of how reliably can you how much reliance can you place on the records. If you have not done the actual physical stock take, then can I say that inventory as is in the books is as it is it really in existence? And as a matter of reporting, Caro also requires the auditors to actually assert whether there is a physical inventory count at least once every year. So the situation threw a lot of challenges around inventory, physical counting of inventory. The institute came up with multiple guidance towards this, and so one of the alternative procedures that were suggested is that you do a rollback or a roll forward procedure. So what that means is, if I cannot do a stock take as of 31st March 2020, I do a stock take whenever it's possible subsequently, let's say 15th of July 2020. And then based on the purchases, the sales, and the other stock movement within the intervening period, I do a roll forward or a roll back of the inventory count, and get to work out and extrapolate my 31st March 2020 inventory balance. So that's how I would have a comfort on the inventory level as of 31st March. So this is what the institute suggested, and a little more innovative suggestion that the institute came up was, you can also use technological. You can also do a physical count of inventory based on technological interest. So you can have a Zoom call with the site, with the project, with the plant management, and then virtually you can actually witness the actual physical count, which was considered to be acceptable in the current circumstance. So these were broadly the two suggestions that the institute came up with. And then some of the companies had an impact of this. So Piramal Enterprises, for example, in their limited review report, the auditors did mention that they were not able to observe the management's year-end physical verification, and then therefore they performed the audit procedures on existence of inventory as per the guidance in the auditing standards. So they did raise an emphasis of matter that we are not in a position to actually witness the physical verification. So to that extent, there is an EOM in the audit report. Likewise, there were a couple of other companies who did also mention that in their the auditors mentioned this in the emphasis of matter. So that was one of the key auditing issues from a COVID-19 standpoint. Any questions, any reactions on inventory, any other experiences that people would like to share? Okay, so maybe I'll then go to going concern. So as we all know, a going concern assumption is one of the fundamental assumption of financial statements. So basically, you prepare financial statements, balance sheet and P&L based on an assumption that the company will carry on, its business for indefinite period. So you don't prepare financial statements based on the assumption that the company will not be in a position to carry out its operation. Its ability and intention to carry on its operations is not is not questioned. So COVID-19 affected companies will need to look at the following in assessing the going concern. So this is coming from the auditing standards. Updated financial forecasts for for foreseeable future, but not less than 12 months. Updated sensitivity analysis, and this is something which is more emphasized in Ind AS financial statements, that you do carry out sensitivity analysis. What that means is, let's say if interest rates goes up or down, so how much will it impact your your liquidity position? If let's say the if you are into oil and gas, and let's say if the crude oil prices go up and down, so how much of that will affect your actual P&L? And so therefore that is one of the exercises that you are required to do if you're in a position that your going concern, your business existence itself is challenged. Forecasted compliance or lack thereof with banking and other covenants for a foreseeable future, and any other information available up to the date of financial statements are authorized for issuance. That is the sign-off date. So auditor has to mainly consider the impact of COVID-19, that is whether it has materially impacted or is it expected to materially impact on the auditor's evaluation of management's assessment of going concern. And this is typically a case for the susceptible sectors. So hospitality, for example, leisure or aviation. Now that, since last few months, hotels were not really operating, or, leisure amusement parks were not. So all the companies which were in that sector, they had to have a serious discussion with their auditors regarding this. And, as also the aviation, so companies like Indigo or SpiceJet, if you look at their financial results, you would find a longish note on, how they have come to terms with going concern assumption. The other part is reconsideration of appropriateness of the use of going concern basis for the preparation of financial statements or consequential modification to the auditor's report as needed. So some of the factors which needs to be considered in assessing this going concern assumption is the impact on the economy and asset prices in general, impact on various measures taken by the RBI for improving the liquidity. So for example, fitness companies, companies which are into gyms listed, we have a few listed companies which are into fitness or gyms. So if gyms were, not working for almost 6 months, then how is it that, they will be considered going concern? Especially if you have significant borrowings, how is it that you will be in a position to actually repay your loans or pay, salaries to your employees? So again, such examples would be there. Impact of various measures taken by RBI for improving liquidity, government assistance, and including economic package. Whether the entity is operating in a highly impacted sector. We discussed this. Whether the entity has the liquidity to continue to meet its obligation as they fall due. Whether the entity has sufficient existing potential borrowing facilities to meet its short-term needs. Whether the entity plans or has ability to restructure its debt obligation if required to ensure solvency. Assessing the financial health of the key customers, vendors, and their impact on entities' operations, and impact of contractual covenants and commitments. So here's an example of a company, Lemon Tree Hotels, which gave a very extensive note in its financial results. And this is an extract from March 20 financial results. It's September results is also, it carries the similar note. So again, because of COVID-19, the operations, there were significant disruptions in the operations of this company due to lockdown and travel restrictions and quarantines and other emergency measures. So let's read the note. With respect to the operations of the group, it has impacted its business by way of reduction in occupancy of hotels and average realization rate per room starting from the month of March 2020, and the management is undertaking various cost saving initiatives to conserve cash. In May 2020, 70% of the group's hotels have been operational at 40% occupancy rate, mainly due to accommodation taken by foreign nationals staying in India, IT companies and hospitals, and for their staff. In evaluating the impact of COVID-19 on its ability to continue as going concern, the possible impact on its financial position, the management has assessed the impact of macroeconomic conditions on its business and carrying value of its major assets comprising of property, plant and equipment, trade receivable and investment in associates investments as at the balance sheet date. In this regard, the management has carefully considered the circumstances and risk exposures arising from COVID-19 situation for developing estimates on the basis of all available information in its assessment of impact thereof on its financial reporting. While assessing the recoverable amount of PPE and investments, the group has used significant assumptions such as hotel occupancy rates, average room rate per hotel, terminal growth rate, and weighted average cost of capital. The group appointed independent valuer to assess the fair values of significant hotel properties owned independently, which covered approximately 60% of the value of the PPE of the group. Based on the aforesaid assessment, the management believes that the group will continue as a going concern and will be able to meet all its obligations as well as recover the carrying amount of the aforesaid assets as on 31st March 2020. Management believes that it has taken into account all possible impact of known events arising from COVID-19 pandemic in preparation of these financial statements. The associated economic impact of the pandemic is highly dependent on variables that are difficult to predict. The impact of COVID-19 is a continuing process, given the uncertainties associated with its nature and duration, and actual results may differ materially from these estimates. The group will continue to monitor any material changes to future economic conditions, and any significant impact of these changes will be recognized in the financial statements as and when these material changes to economic conditions arise. So basically what they have done is, as a mitigation to going concern challenges, they have got their properties, fair valued and assess that whether those fair values are good enough to kind of, make up for the losses. So if my main assets are investments, property, plant and equipment and trade receivables, what they seem to have done is that I have got a valuation of the properties of 60% of the properties and compared that with the carrying value. If I'm good, if the fair value is higher than the book value, I would say that they seem to have said that it's fine. I don't have any impairment issue. And imagine if this is a hospitality, this is a hotel company which has properties. But let's say had it been an aggregator, let's say like an Oyo room, where you may not have, a property to actually back up your going concern assumption, then in that case, it will be very difficult to actually say that, I am a going concern, because you may not have revenues, to the tune of your normal revenues. And therefore, you will have a serious issues with regards to going concern. So the auditor of
Santosh, I want to ask you one question. So, like, suppose I have airline companies wherein the debts are these assets are lease finance. So those companies will have these owners of those assets. So how will they give a
webinar.
going concern disclosure? Do you have any idea on that?
So we have, so that's a good question. So we have another example of Indigo. We'll come to that. But
Okay.
see, to answer your question, if I have a leased asset, okay, and if I have, my operations on the revenue side, I'm not able to fly my, fleet. In that case, there would be serious going concern issue. So at least in case of lemon trees or let's say India hotels, we have, they have owned properties. So they have, a real estate asset to kind of back their going concern challenges. But if I don't have that, let's say if I don't have any asset which is, that much valuable, then in that case, I would really have challenges on going concern. What is that nail that I can hang my hat on? That's really the question. So here, basically, if I have debt obligations, I cannot say that fair value. I'll consider the fair value of the leased assets, because that's ultimately that's not going to realize ultimately. So I'm not in a position to sell the fleet in any case. So I'll have a problem.
So when we speak about operating lease to be disclosed in the balance sheet, so there'll be a huge impact of these, because when I speak about these finances, which is basically even in PVR, I have seen that these area space what they occupy is being financed by individuals or say group of people, and they lease it on to them. So that situation will make these entities very vulnerable.
Very susceptible. Yeah.
Yeah.
So no. So one thing is you're absolutely right. Last year and March 20, we saw a lot of companies who are heavy on leases. PVR is a good example. Aviation companies, hospitality companies had significant assets and liabilities, operating leases, which otherwise were disclosed as notes in disclosures. They made their ways in the balance sheet. So that was a major impact last year. This year, again, we have some amendments which is coming up, which are covered in the subsequent slides. And again, that created a significant accounting, challenge. So we'll see that in a later slide. So here the point is lemon tree hotels. Auditors also raised the emphasis of matter.
Santosh,
yeah.
I have one question.
Sure.
This is Ravindra Singh from Indian Bank, Ludhiana, AGM. Actually, we have financed the malls in various cities, and they are not opening yet or not yet fully operational. What will be the impact on accounts in these companies? We have financed the lease and discounting.
So let me just repeat your question. So you are a bank. You have financed.
We have financed the mall owners against the lease and discounting, and most likely all the malls are not yet opened or partly opened. So in that case, what will be the impacts on accounts?
So ideally, sir, what happens is if the mall company will be like a real estate company.
Yes.
So there you will have two things. One is the first issue is whether there is an impairment. Okay, so whatever mall I'm owning, okay, I would have classified it as property, plant and equipment or investment property, because I'm leasing it to retail operations or for
right.
for food halls and all that. I'll call it as a investment property, which has to be tested for impairment. Now, non-occupancy is an indicator of impairment. So there'll be two things. One is I do an impairment basis the projected cash flows. So typically, mall owners, the way they do their impairment is they do a kind of a discounted cash flow. They have lease agreements, right? So if I say that I have a total leasable area of whatever, lakhs or thousands or whatever,
Yes, yes.
I per square feet on an average, my lease rental based on actual agreements is whatever it is. Okay, so
Yes.
for next 30 years, that is for the total useful life of the mall, I project that, you know, if it's leased and let's say with an assumption of 5% escalation every year, I mean, it can be lower this year because of COVID. So let's
Yes.
say 3% escalation every year. I project the cash flows for the next 30 years. I discount it at the current, you know, my cost of capital. That value I'll compare to the book value. If that value is higher than the book value, I'm good. So I won't have any impairment issues. The other way of doing it, and what apparently this lemon tree has also done, is that they have actually done the actual real estate valuation of the underlying real estate. Okay, that agar main aaj ke din mein, if I'm selling this property, what is the value I'll fetch? And if that value, if it's higher than the book value, then I'm good. I won't have any impairment issues. So, sir, to answer your question, you will have to see whether there is an impairment. You will have to actually ask them कि आपके books में कोई impairment है क्या? What's the impairment analysis that you have done? And if possible, you can catch hold. You can request for the impairment report that they would have got for the purpose of their balance sheet.
Thank you.
From an auditor standpoint, generally when there are significant doubts on going concern assumption, you will find an emphasis of matter in the auditor's report, and this is the case in lemon trees as well, where the auditors have actually drawn down an EOM in the audit report. Now coming to the aviation example, Interglobe Aviation, Indigo Airlines. So they again provided a very long note in their September financials, and obviously they did mention about the actions and the mitigating factors. So I'll read so let's read this. Our scheduled operations resumed from 25th of May 2020 with certain capacity and fare restrictions imposed by the central government. There were additional capacity restrictions imposed by various state governments for considerable part of the first quarter, which had impact on the pace of our capacity deployment. As a result, our revenues were materially impacted due to this period. During this period, we have taken several actions to mitigate the effect of COVID-19 on our business. We have taken steps to reduce our unit costs and increase our liquidity by making our fleet more efficient and continuing to substitute under CEO aircraft and NEOs, prioritizing flying with our NEOs over older CEOs, putting on hold discretionary expenses, deferring certain capital expenditures, sale and leaseback of our owned asset, etc. In order to sustain operations, we also had to take action to cut employee costs through pay cuts, leave without pay, and reduction in workforce. We are ramping up our operations in a phased manner, subject to government directions. We have sufficient fleet and crew and other operating staff available to scale up operations across networks to cater to the demand, strictly adhering to safety and social distancing norms. We have introduced a number of measures as a part of new standard operating procedures like spray cleaning, etc., etc. Due care has been exercised to determine recoverability of carrying amount of assets while preparing the company's financial results, and as of for the quarter ended 30th September 2020. We have performed sensitivity analysis on assumptions used, and based on certain estimates expect the carrying amount of these assets to be recovered. We have a strong cash position as of 30th September 2020 and hold our current investments in highly liquid funds and bank deposits. We have met and expect to meet all our ongoing cash obligations pertaining to our lease rentals, debt repayment, and any other financial obligations. The unprecedented nature of the pandemic makes the future business environment uncertain. However, we will continue to carry out the impact assessment on our assets and closely monitor any material changes to future economic conditions. So very detailed note. So they seem to have significant challenge, and for the reasons that we all would appreciate. But so this is the kind of analysis that they seem to have done. The auditors have also given an EOM and emphasis of matter in their audit report towards this. And then coming to Tata Steel. So Tata Steel in its Q2 results have also made a mention about their UK operations, the going concern assumptions about UK operations, Tata Steel UK, where they have said that given the severity and length of the downturn in steel demand on account of pandemic remains unpredictable. The directors of TSE, that is Tata Steel Europe, observed that while there is reasonable expectation that TSE had adequate resources to continue operating for foreseeable future, and that going concern basis for preparation of financial statements remains appropriate. There exists some material uncertainties surrounding the impact of COVID-19 pandemic on its financial situation. The financial statements of TSE are prepared on a going concern basis. So again, steel, the demand for steel, etc., that is something which they have, that is, causing the going concern assumption to be challenged, and that is what they. So they have taken some steps to mitigate that. Questions on going concern? Any other questions? We have had a couple of questions. Any other reactions or questions to these disclosures or to going concern?
Yeah, hi, it's Hardik. Just some quick thoughts and question. So let's say a company evaluates itself or its subsidiary or whatever the case, and determines not a going concern or will not be a going concern going forward, and values its assets on a whatever realizable basis because it is not a going concern, and prepares its financial statements and moves on as in financial statements are on non-going concern basis.
Yeah.
Let's say the situation gradually improves as we are all hopeful with the vaccine, etc. And the company suddenly, or not suddenly, but gradually becomes a case for going concern again. Is there any recommended or suggested accounting treatment in any of the gaps that you're aware of on what to do? Would it be more like a correction of an error, or would it be more like a change in estimate, or neither, some third treatment?
Yeah. No, so that's a good question. Basically, the problem is that while Ind AS and accounting standards and all our accounting framework lay out that going concern is the fundamental assumption, none of the standards, neither IFRS nor Ind AS, provide any guidance on how do you draw down financial statements on a non-going concern basis. Okay, so while there is no guidance in IFRS or Ind AS, US GAAP does provide, there is one of the ASC which covers how do you prepare on liquidation basis financial statements. So basically it says that, you do it based on realizable value, as you rightly mentioned. So all your fixed assets, your investments, etc., you restate at their realizable value. Likewise, on liability side, if you have, let's say, gratuity obligations, etc., you have to state it at a realizable value. Now, when the scenario changes, let's say from a non-going basis, a going concern basis, it becomes a normal going concern basis in a, let's say, a span of a couple of years. in that case, what happens is it won't be an error for sure, because there's no error, there's no omission or error which the company has made. The framework changes. So then what happens, that from a liquidation basis, you will have to transition to a normal basis, historical cost basis. And in that case, again, there is no guidance. So there is no guidance on situation where you were, earlier you were assessed as non-going concern, and then you turn around and you have a situation where you're now a going concern entity. It's not an error for sure. It would be like a fundamental change. So you will again go back to your historical cost or your normal Ind AS requirements, and then prepare your financial statements. So in the meantime, you will have certain. So when you draw down the realizable, the balance sheet on a realizable value basis, you will have certain losses. So in that, or provisions. So when you draw down the books or the financial statements again on a going concern basis, you may have to reverse those provisions. So no clear-cut guidance in Ind AS or in in Indian accounting framework, but one can look into the guidance in US GAAP and draw an analogy from that.
Yeah, hi. So the only reason why I mentioned correction of an error is because it could fall upon your original decision whether you judged moving from going concern to non-going concern properly, since you managed to revive yourself at a later date. Yeah. Okay.
It may not. Yeah. So you're right. So there could be questions on whether the decision was correct, but if you can back it up with at that point in time you had given the situation at that point in time, you didn't have much of a visibility regarding your continuity. So perhaps it can be like a change in situation rather than an error. So that can be one way of looking at it.
Okay, thanks.
Sure. Anyone else on going concern? Now, going concern is typically not a very common thing. Of course, in these unusual circumstances, we have these uncommon discussions. Otherwise, going concern is not a very commonly discussed accounting matter. Okay, now going to employee benefits. Now, from employee cost perspective, there were implications. There were accounting implications. Many companies had to lay off their employees, as we also saw in that Indigo Airlines results. They mentioned that they laid off companies. Some companies did, maneuver their compensated absence or leave policy. Many companies also had to remeasure its gratuity benefits. Now, what happens is gratuity is measured based on projected unit credit method under AS 15 or Ind AS 19. And whenever there's a significant change in the assumptions, you would have a significant impact on the liability. So many employee heavy companies, for example IT companies, had a significant increase in their gratuity liability. The other reason is that when you discount the gratuity liability, you do it based on the guidance that it is to be, you have to use your discount rate of the government bond yield. Now, because there has been a decline in the general interest rates, your government bond, so your discounting rate for the liability has also declined, and therefore you would have a higher liability. So that also contributed to the higher gratuity benefit liabilities. Many companies did also restructure their employee stock option plans, and because the vesting conditions were not in a position to be met. they had to kind of modify the terms and conditions of their share-based plans or their employee stock options, and therefore, they had accounting implications of that. So here's an example of a company which came up with a VRS scheme, and this is an extract from the September financial results, where it said that certain locations to improve the productivity and competitiveness of its business and incurred cost of 21 crores for the quarter and year ended 31st March. Further, during the quarter ended 30th June 2020, the company incurred a similar cost of 8 crores on another VRS. Coming to property, plant and equipment, again, many retail companies especially had to revisit their useful life of their fixed assets, simply because for months together, if their stores were closed and the air conditioners etc. were not switched on, there would be an issue of their leasehold improvement or their interiors not functioning properly, and therefore they had to revisit the useful life of electrical equipments or the interior leasehold improvements, and they had to accelerate the depreciation. So Shoppers Stop is an example of a company which had to do that, and they had to accelerate the depreciation, so that caused a higher depreciation charge and therefore a lower profit for the period. So you mentioned about 116, Ind AS 116 or the new leasing standard. So basically, before coming to the amendment, so in FY20, we had a new accounting standard applicable under Ind AS, which required all operating leases to be captured in the balance sheet. What that means is that if I have a lease, let's say for 5 years, earlier I used to expense the lease rental annually, okay, as I go ahead, and disclose the lease commitment as a part of my notes to accounts. Now what I'm required to do is, under this new standard, under Ind AS, I have to actually project the cash flows for the entire 5 years on day one. I have to create an asset and I have to create a corresponding liability. So my balance sheet is therefore grossed up. I have an asset on one side and I have a liability on the other side. And therefore, there is a balance sheet gross up. The asset which I'm creating and nomenclate it as a right of use, because the way the standard looks at it is I am basically having a right to use that asset for a period of, let's say, 5 years. So I have to depreciate that right over 5 years. The lease liability that I create, it's on day one, it's created on the present value, the discounted value of the future cash flows. So there will be an impact, there will be an interest, there will be a notional interest cost on account of unwinding of the discounting that I did on day one. So therefore, there will be a notional depreciation or amortization of ROU asset, and there will be a notional interest cost on account of unwinding of the discounting. So while I actually pay a lease cost, a rental cost in real life, my P&L will not have a rent expense. My P&L will only have a notional amortization and a notional interest cost. So that's a kind of the short summary of 116. Now,
that
what
will
happens?
significantly increase our leverage ratio.
Absolutely.
And debt service coverage ratio.
Yes. So it will increase debt equity ratio because you will have higher. So for example, if you look at a company like TCS, which is otherwise a debt-free company. So last year, as a result of applying this standard, it booked a liability of around 4,000 crore, if I remember it correctly. Around 4,000 crore lease liability it booked in. So for the first time in history, it had some financial liability in its books. So a lot of
do I require to represent my financials, because like some of my liabilities which were actually part of the expense and does not form part of EBITDA at that point of time, now that should form part of my EBITDA for my DSR calculation?
No, yes. So EBITDA will have to be relooked, recalculated. Now, because as I said, the rent cost was earlier part of your operating cost and therefore part of your EBITDA. Now, what we have is an artificial amortization and artificial interest cost, which will be which will be not included in the EBITDA. So it has been EBITDA positive for all the companies, but it has been debt equity negative for all the companies. So if now, for example, many retail companies last year, they transparently mentioned that this is my profit, this is my EBITDA pre-Ind AS 116, and this is my post-Ind AS 116 EBITDA. So analysts can readjust their performance measures to accommodate this change in the accounting and to kind of benchmark it with other companies. So you're right. So one will have to ideally recalibrate the EBITDA and debt equity as a result of this.
So I'll have to show two financials when I do a reporting.
No, so not in the audited financial statements, but in the analyst presentation, in the investor presentation, I will have to, if I want to be very transparent, I'll show that this is not my true EBITDA, this is my post Ind AS 116 EBITDA, because the accounting standard requires me to create a fiction of interest and depreciation, but my actual cost is my rental cost. Therefore, it's I may also adjust it for the notional notional interest and so I can have an adjusted EBITDA also. If I have to be very, very transparent, I can say that this is my GAAP EBITDA, but this is my adjusted EBITDA, because I don't want to I don't want my EBITDA to be affected because of that.
And this will require my bankers to look into the covenants, what they may have set in the lending time, and may revise it accordingly.
Absolutely. So the covenants may not have taken cognizance of the changes in Ind AS in the leasing standard. So ideally, bankers would have to understand the impact on the borrowers and actually also recalibrate the EBITDA covenant in the loan agreement.
So I have someone writing, Mayur has just written that lease liability still not be required to be as a borrowing. Hence, I believe it will not impact debt equity ratio.
No, so that's a way of perception. So that's a perception. So I agree. So in real life, there's no loan. Okay. The gap, the way it gets presented in the balance sheet is financial liabilities. But obviously, it doesn't mean that you have borrowed funds, because leasing is something which is integral to the operations of the company, and therefore, and because the standard now requires you to capture your leases in your balance sheet, that's why you're doing this. But obviously, it doesn't mean that you have borrowed funds or you have a higher leverage. So I agree that it's you don't actually have there's nothing which has changed fundamentally. So till last year, TCS, if didn't have any leases on its balance sheet, suddenly this year, because the standard requires you to capture leases on the balance sheet, doesn't mean fundamentally you have actually borrowed externally. So it's a matter of perception, and it's a matter of changing the changing the parameter, the debt equity or EBITDA.
May you hope, yeah, thanks.
So I agree that fundamentally there's no change. I mean, suddenly because the standard requires me to do it the way it wants me to, doesn't mean that the way I am carrying out my operations is changing. So that's absolutely right.
Yeah, thanks.
Okay, so what's the change in this? So if that thing was very complicated, what is the change which is now kicked off? So the background to this is because of COVID-19. Okay, many lease agreements have got restructured. Okay, now these companies like PVR or Domino's Pizza or McDonald's, they have reached out to their landlords or to their lessors and said that we cannot be paying you the same lease rentals that we were paying you earlier. So you need to give us some concessions. The problem is the standard, the way it deals with lease concessions or any modifications in the lease agreement is highly nuanced. So what happens is if there's a modification which was not earlier envisaged in the original lease agreement, then I have to recalculate my lease liability based on the revised cash, payouts, the lease payouts, and I have to rediscount it at today's rate. So interest rates also would have undergone change and it would have declined. So it may be possible that despite of lease concession, because of the decline in interest rate overall, I will have a higher liability. So if the discount rate reduces, my liability, if it's a liability that I'm dealing with, it increases. So it shows a kind of a counterintuitive position that while my lessor has given me a concession, my liability is actually increasing. So there was a confusion. Secondly, the way, so imagine the plight of a company like, let's say, Metropolis Healthcare, which has 2,500 leases across India. So if I have to do this for each and every lease, then it will be a Herculean task, because every concession, every landlord would have given me some typical concession. So there would be different permutations and combination of the lease concession that I would have got from so many landlords. So it would be very difficult to actually calculate, the actual modification impact. So internationally, many companies went to the International Accounting Standard Board saying that this is getting too complicated. Anyways, COVID-19 is impacting us. Financial reporting, accountants are working from home and all that. So how do you expect us to do all these calculations and meet with these requirements? ISB said that, hang on, we'll give you a relaxation. So it speedily, it kind of triggered an amendment to IFRS 16, which trickled down to amendment in Ind AS 116 as well. What that amendment says is, don't worry about all these requirements. If it's a COVID-related concession, that is, if the concession, if the lease, the decrease in the lease rental is, because of COVID, that is, it's between now and June 2021, the month of June 2021. And there are no other, substantially no other changes in the lease agreement, then don't worry about it. Whatever modification, whatever savings you have done as a lessee, you take it as an income. Okay, so don't get into that jhanjat of recalculating this lease liability, afresh. Keep it as it is. Just whatever concessions you have got from the landlord or from the lessor, you take an income, you book it as a other income. So your life will be much simpler and much more decomplicated. So that's the concession. So they gave a practical experience. It's an optional thing. You can still go for the more complex accounting, but if you're meeting these three conditions, that there is the reduction, so the change in lease payment results in revised consideration for the lease that is substantially the same or less than the consideration of the lease immediately preceding the change. Any reduction in lease payments affects only payments due or on before 30th of June 2021, and there is no substantive changes in other terms and conditions. If these three conditions are met, then you don't need to worry about it. Whatever lease savings you have done, you can recognize it as other income. Yeah. So many companies in retail sector opted for this practical expedient and booked an income. It was a kind of a no-brainer for many companies that one has to opt for this because A, it's easier, and secondly, it also enables me to kind of book more income. So what's the harm in that? So Shoppers Stop gave this note in its September 20 financial results, saying that we have used this exemption the impact of that also tabularly they depicted in the results. So basically their other income was higher by about 27 crores. So in a scenario, in a quarter where, there was hardly any revenue on account of people coming to stores or people buying online, I think this other income would have helped them to show some, some good results. Likewise, Future Retail also used this experience, this amendment, opted for this amendment and booked an income of about 131 crores. So again, this would have helped to retain some of the EPS or profits for the quarter. Questions on this? Yeah.
Yes, I have a question. Thank you for the insights on this matter. And I'm an analyst by profession, and just wanted to understand where. So when I look at the results of companies like let's say similar in the similar domain in the fashion and retail domain, apparel domain, like Aditya Birla Fashion, and when I see that just like the way Future Group and Shoppers Stop have accounted for it, I think all companies have counted this lease concession as other income.
Yes.
And so that means that the way you have what you mentioned that the lease accounting, the Ind AS 116 accounting remains unchanged. It's just that on the income side of the profit and loss statement, whatever concession you get for this interim period, you account for that as another income, so that the net of your net of EBITDA gets benefited to that extent.
Yes.
So that is the right way to put it. Firstly.
Yes. So
Okay.
basically, just to kind of reframe what you said, had this amendment not come, then what would have been the scenario that if there is a lease modification, okay, then I would have had to sit and project my new lease rentals, considering the concession, and discount the cash flows, the future cash flows for the the leases under the leases using the current discount rate, which would have been less than the original discount rate, which I had used in April 19. And therefore, see, whatever impact comes, whatever the delta I would have, it would have been almost P&L neutral, because I have a reduced liability, okay, or a higher liability, and consequentially, I'll debit or credit the ROU asset. So broadly, it will be P&L neutral. Okay, that would have been the scenario. This relaxation which this Ind AS this amendment gives is that it says don't worry about it, because you may hundreds and thousands of leases. If you have to do that for each and every lease, life would be much more complicated. Okay, so don't worry about this. Whatever concessions you have got, whatever reductions in leases you have got, you book that as income. You don't disturb your original calculation of projected, lease rentals and ROU. You keep it as it is. You continue discounting and you continue amortizing your ROU asset and continue unwinding your lease liability as you were doing earlier. Whatever concessions you have got, you take it in P&L as income and then kind of forget about it. So it was a more simplified application of the standard as against the original standard. You had another question also, right?
Yeah. So got it. This is very helpful. And secondly, what I wanted to understand is that excluding, okay, there are two questions I have on this. So first is that you mentioned that there are certain conditions which, whereby if these conditions are followed, you can actually adopt this practical expediency guideline and account it as other income. But what I read was that there was certain timeline limitation with respect to rents due only up to June 30th. And also there was something, what I could not understand was that if, let's just say standard, if I operate a store on in agreement with the landlord, and the landlord says that, till financial year, till the end of financial year 21, which is March 21, whatever revenue you make, give me 10% of that. And that is actually a very significant discount which the landlord is willing to accept, because otherwise the landlord would have earned maybe, let's say, 2-3x more than what he could have done in this period, because of course company is also not making money, so landlord would definitely not make any money.
So sorry, what is the landlord saying? 10%?
Landlord is saying that whatever revenue you have, so instead of a fixed rent, whatever revenue you have for till March 21 monthly, I'll take 10% of that.
And I will not take any fixed rental.
Yeah, there's no fixed rent. It's all variabilized. So then, in that case, what happens is that, let's just say landlord used to earn a rent of, let's say, 5-6 lakhs a month, and given the way revenues are, the landlord practically ends up earning, maybe I would say, 2 lakhs, 2.5 lakhs a month. It's a 50% discount to what he's earning, and the company is benefiting. Of course, company is not benefiting, companies anyway. So point is that it's a significant change in the lease structure, lease terms. So will that affect the lease accounting, or you would say
Yes.
that even
Yes,
that benefit?
because see, now this concession, if it's until March 21, the prerequisite of this amendment is that it has to be before 30th of June 2021. Now, why did the institute choose this date? First of all, let's understand that they wanted to give this, they wanted to restrict this amendment only to COVID-related concessions, only to COVID-related reductions in the lease payments. Now, how do you define what is COVID-related and what is not COVID-related? So they thought that let's invent this bright line of 30th June 2021, because they were saying that anything beyond that, we don't expect this pandemic to be lasting beyond June 2021. If the concession is beyond June 2021, then there is then you don't have to, so then you cannot, you are not eligible for this amendment. Then the assumption is that then it's not related to COVID, it's something beyond that. It's not a COVID related amendment. So therefore, they set up this bright line of 30th of June 2021. In your specific case, what will happen if I'm variabilizing the lease rental until 31st March 2021? So it's eligible for this amendment A. Now, how it will work is the fixed rental that is getting waived off will be booked as income in other income, and the variable cost. Now, when I set up my lease liability under Ind AS 116, I only consider the fixed lease payouts. I don't consider the variable payments. So if it's linked to revenue, that's not project. So the standard doesn't permit me or expect me to actually anticipate the revenue and set up a liability based on 10% of that. So you will have a big chunk of other income in your P&L in your specific scenario, and the cost of the 10% rental, the contingent rental which I'm paying will be expensed as you earn that revenue. So every month, whenever you have you freeze your sales figure, 10% of that you will expense in the P&L. So you will have a significant impact in the P&L on account of this change.
Got it. And just two small questions. It is in relation to what the other gentleman was asking earlier. So, while assigning the rating, do the rating agencies consider the lease borrowing? I mean, the lease liability as a part of borrowing while doing the whole rating calculations, or how do they do it? I mean, is it considered as a part of borrowing by the rating agencies?
So I'm not part of credit rating agency. They shouldn't ideally. I'm not sure. Answer is I'm not sure, but in my view, they shouldn't do it. But I mean, if somebody from the group within the group is from credit rating, agencies, then they may perhaps answer that more accurately.
So basically, hi, this is Pramod Agrawal this side. So I'm not from the credit agency, but I deal with the credit agency and for the credit rating and all. So yes, they consider it, but they don't give it a very high weightage. So they consider it definitely because it becomes a lease commitment type of thing. So they try to find out the thin line between what is your committed one. So what is under the fixed tenure, and what is something which is been coming to you as a liability on a renewal and where you have an option. The things where you don't have an option, they consider it very truly along with the borrowings. Where you have an option of cancelling or something, they consider it normal. They don't bring it in those credit exercise. So that's precisely is my view. I think if Ramesh is there, so Ramesh will able to give, because he is king of rating agencies.
No, that's useful, Pramodji. So
It's very helpful.
whether it's AS company or Ind AS company, that shouldn't matter, right? So what you're said. So basically, then, if I'm having the lease liability in my books, or if I'm showing it as a notes to accounts, either which ways you're saying it will be considered.
Okay.
Yes, that is what I'm trying to communicate.
That's fair point.
Okay. Thank you very much. Thank you.
Okay, going ahead. So we saw this, and again, lemon trees. Some of the hotel companies also, this hospitalities also did take advantage of this. Basically, see, from all these the companies in these sectors which are highly susceptible to COVID-19, it's kind of a no-brainer. It's easier and it gives a good income in the results, so they would go for this. Contract termination penalties. So this we again discussed earlier. So basically, the moment you have an onerous contract, or if you have any penalties or liabilities emerging from termination, of your long-term contracts, be it with vendors or lenders or for customers, because of COVID, if you have not been in a position to honor those, those conditions, you will have to make a provision towards these penalties, or if there are any consequences of that, you will have to make provision towards penalties. An example of that was in this Indigo, where one of the OEMs actually, there's a kind of a claim between the airlines and one of the OEMs, and this is the note that they gave in their financial results in September. So they did not make a provision towards it, but they have explained why, based on some legal opinion and all that, they considered that it's not something which will fly through.
So Kishore, you want to say something? I can see you have raised your hand.
Yeah. My query was regarding in the how this lesser will account. Whatever Santosh has what is regarding how this lessee will account.
So Kishorji, the lessor accounting hasn't changed under Ind AS 116. So the lessor will have the fixed asset in its books.
Yes.
Okay. So lessor will have to assess whether it's an operating lease or finance lease.
It's an operating lease.
Sorry, sir?
It's an operating lease in the books of lessor.
In the lessor's books, if it's operating lease, then you will have the fixed asset in its asset side, the actual fixed asset.
Yes.
Mind you, the lessee records the asset as a right of use asset, kind of an intangible asset. He doesn't record the actual fixed asset in the books. So he's just recording an asset by the nomenclature of right of use. The lessor will have the fixed asset in its books, and it will continue to depreciate that asset. And as and when the lease rentals are due, the income will be booked in the books of lessor.
So the lessor is doing straight lining of the lease rent for the lock-in period.
Yes.
So earlier there was fixed rental, so and periodic escalation in the contract. So the straight lining was easier.
Yes.
Now because of COVID, there is contingent rent. The rent for say 6 months is based on some sales recorded by the lessee.
Yes.
So for those 6 months, the rent is not fixed.
Yes.
So whether that 6 months period and as well as the contingent rent will be factored in my straight lining, or I have to ignore both?
So contingent rent, the standard says that you don't anticipate the future sales, and you straight line that. You account for the contingent rent, whether you are lessee or lessor, on a as is when is basis, on accrual basis. Basically, you don't anticipate that in set up a liability or asset. So whenever the sales is booked and whenever that sales figures is crystallized, the contingent rent, whatever percentage you have agreed, that you book as an income as a lessor, and you don't consider that in the straight lining process.
Okay, so the rent income as well as that period of 6 months I have to remove from my straight lining working.
Yes.
Thank you. Thanks, Santosh.
Sure. Okay, debtor provision, again a very, very significant impact. So,
Santosh?
Yeah.
May I ask a question? Okay,
Sure.
Santosh, how is this the tax treatment from both lessor point of as well as the lessee point of view?
See, now from tax perspective, the only impact is when you're actually in MAT, in 115 JB. Because in 115 JB, the basis is book profits. And of course, the companies that are now in MAT post this new reduced tax regime is that much, it has reduced. But if you are for some reason, let's say if you are, still taking benefit of some deduction under income tax, you may be under MAT. So under MAT, as per 115 JB, you will have this, whatever we discussed, this will impact your direct tax. It will be based on, so whatever interest, be it notional or whatever amortization, that will affect your taxability from a MAT perspective. From normal tax perspective, the ICDS standards have not changed. Under section 145 of Income Tax Act, you have the ICDS, the Income Computation and Disclosure Standards, where basically income tax has its own code or own, own accounting basis. So that has not changed because of 116, Ind AS 116. So if you're under normal income tax, you will only get deduction for the rental cost. Okay, not for the notional interest or amortization. Likewise, for the purpose of TDS also, you don't, so you have to deduct the TDS based on rental TDS, not based on interest or, so that remains same.
Yeah, TDS has to be deducted on the actual rent which has been paid.
Exactly.
Right. So there is, okay, for TDS it is the actual transaction, not the revised one. Okay.
Absolutely.
And the savings. And but in case of this particular, what we are right now showing is that the profits which you have been showing because of the savings in the rent in case of this lesser.
Yeah.
So all these things will it be taxable in the hands of the lesser? Like future groups and all these things who have shown this, the shopper who has booked the income. This extra income, additional income, will it be taxable?
In the
if it is normal taxation.
Yeah. So in the hands of the lessee, you mean to say, right?
Yeah.
So that's what. So if you're a MAT company, this will be straight away taxable.
Okay.
If you are not a MAT company, if you are under the normal provisions of income tax, then the reduced rent will reduce your deductions. So it's not an income from a tax perspective. It's not a income as such. Okay, it's a reduced deduction because see, ideally you would have got deduction on account of the actual rental that you are paying.
True.
Now, because that actual rental has gone down because of the COVID concession. So whatever expenses you're claiming as deduction under income tax, that will reduce and therefore indirectly it will get taxed.
Okay.
But not in the manner that Ind AS 116 will get you to as other income, which will be taxed only if you are under MAT. The one.
Yes. Okay. Thanks.
Yeah. Okay, so ECL, expected credit loss, big issue for companies when realization will be happening, especially companies which have exposure to, government sector. So, for example, fertilizer company, where let's say 90% of its business comes from government. The money is due from the government company. So again, that is a big challenge. How do you go about it? And I have some NBFC examples as well, where the way ECL is to be computed is much more nuanced and complicated. So Mahindra Finance, for example, gave this note in its September results where it mentioned that we have done this this staging of loan, of loan book based on stage 1, stage 2, and stage 3. But because the problem actually, I mean, to put it very shortly and crisply, that the issue is that I, as an NBFC, if I have to do this ECL provision, I have to first compute my DPD, my past due, based on the actual figures, and then extrapolate it for future. Now the challenge comes where I have a loan book where many of my borrowers have gone for the moratorium. So therefore, I may not have a delay. I may not have my history for last 6 months. Okay, from April to September, it may not show that there is a delay in realization because there is a moratorium anyway. So what is due and what has not been realized on the due date, because the due date itself has been relaxed by RBI. I don't know when exactly my what exactly is my trend of DPD. The other complication is because I have to extrapolate, I have to do a future crystal gazing kind of an exercise. My loss given default or my probability of default, I don't know what when exactly, what is the borrower behavior that I'll see in future, because I don't know when exactly this COVID will settle down and I'll start getting the repayments. So again, this how to set up the future PD or the future the 12-month or the lifetime probability of default is something which people are struggling with. And of course there are certain methods that the institute or internationally some of the firms have actually recommended. But again, it's all very, very judgmental and very, very subjective. So many of these large NBFCs, they have given a very detailed note in their results saying that while we have done this and while we feel that this is something which is acceptable, but we don't know. Tomorrow it may change drastically depending on what the borrowers actually do after the moratorium. So this is a note which I've seen in almost all the large NBFCs, be it Mahindra Finance or L&T Finance or Bajaj Finserv. And in fact, what many have done is, while the methodology gives them a provision figure of whatever it is, they have topped it up based on a broad management overlay provision. If you look at the last paragraph of this extract, they have said that they have the cumulative amount of management overlay provisions stood at rupees 148 this is in lakhs, so around 1,484 crores in standalone basis and 1,674 crores on a consolidated basis. So they have, as a management overlay, they have topped up the provisions more by a few crores, so that tomorrow, even if there is delinquency, they have enough headroom to accommodate that. So this is the plight of the so far as Ind AS is concerned. This is the major issue in NBFC sector, that this ECL provisioning, how do you get it accurately, and how much is enough? That's the main kind of discussion point, and that's what they have disclosed.
Santoshji, you were talking about the dues from government.
Yeah.
So basically, you can put some light on that also, if possible, that how that will be, because in income tax, I have personally faced the problems where that you have a dues from the government, and somewhere if you are taking a provision for doubtful debt or you are creating an ACL on that, so they say that how can you do a ECL or a provision on a sovereign type of because government risk is considered a sovereign.
No, that's an issue which has come up with the institute, the accounting standard board of the institute also.
Right.
Many companies, said that how can you have ECL on government, dues? Now,
exactly.
The problem is that Ind AS 109, there are two there are two sources of ECL. Broadly, there are two sources. One is delinquency, that is the default risk. So when we say that it's all sovereign backed and all that, it's all great. So you will not have a default, hopefully, especially from a central government due. State governments is still, a question mark, but at least central government or central PSUs will not default. The other thing is delay. So if I'm having a debtor which has a credit period of say 30 days, and अगर मेरे को गवर्नमेंट से पैसा ही 3-4 साल बाद आता है, what the standard says is if the debtors are paying you, there is no default risk, they are paying you, but they are paying you late invariably, then you are losing out on the time value of money. Ind AS, one of the main things is you account for time value of money, right? So even if you have interest-free deposit or interest-free loan between group companies, you still have to do discounting because you want to account for the time loss of money or time gain of money. Now, because government dues in India, unfortunately, they take a lot of time to realize. The standard and the institute also said that since you have a delay risk, okay, and a trend where you have a delay in your realization, you will have to still make a provision towards ECL. Now, to explain these to the tax folks and all that, it's very difficult. Now, but then see, sir, ECL anyways is not deductible for tax purposes because it's a provision all said and done. So that is something which is there, but it's a difficult issue. So for government dues, it's a matter which you need to make the provision for delay risk rather than default.
Right, sir. Okay, thanks, sir.
I think
Mayur has raised the hand. Can share the video and speak. Mayur, you can share your video, put on your video and speak.
Hi, Mayur. Do you want to speak? You have raised your hand. Yeah.
Santosh, you can carry on till he comes again.
Yeah, I'm pretty much done because that was the last slide which was there.
Wonderful, a great presentation, great slides. I would request now Pramod Agarwal, we already felicitated him, if he can put on his video and share a few thoughts and also share latest developments in industry. And Yogesh also, you can also join in. Yeah, wonderful.
Hi, everybody.
Wonderful to have you. Welcome, Pramod, and congrats to you for the great recognition by ICAW. We already had a small felicitation. Wonderful. Keep it up.
Yeah.
Keep it up.
Thank you very much. And I'm very sorry I was not able to join on time because I had some emergency meeting kept by my boss. So India still boss is the topmost priority. In the office and even if in the house also, the house boss is also, everybody knows who is the house boss. So yeah, good. Thank you. And from my side, congratulations to Hardik also. It's really I feel proud and by felicitating in this particular the group where everybody is learned, and I feel more learned than me. Most of the people in the group, but still, if they are recognizing me, it's you people have made my day. Thank you very much.
Yeah, Pramod, congrats. Hardik, congrats. Sorry, I joined late, so I'm congratulating now.
Thank you, Dushyant. Now this is the new look which I am seeing yours with the beard and all. Thanks.
Yeah,
thanks,
it's a lockdown look.
Right.
For benefit of all, I'll share. Dushyant Shah has been a director of Hindustan Petroleum, expert in petroleum sector. He has been General Manager Finance of the HPCL listed company and an active participant of the team. Always.
So even as Manoj said that he is expert in petroleum sector, but I remember whenever I had a discussion with Dushyantji on any sector, he is actually much more prepared than anybody else. I found him. So he is really a great thought leader in the group, and I actually salute him for that.
So after I'm happy to hear these good words, but so more of a sharing of whatever you know. That's the thing.
Yeah, that's true. I agree. But yes, definitely, I found him you as a really a great knowledgeable guy in the in one of the known circle of mine. I'm really feel sometimes happy that I am known to people like you.
Yeah, thanks. Yeah.
Thanks, Manoj, for giving me an opportunity to speak for a few minutes. So from I work in an insurance industry, and during this pandemic, the only industry which has been posted a growth is the insurance industry per se. And when we started it in the month of March, we presented a budget where we have considered the industry will grow with 14%. And after this lockdown and all other things has come up in the month of May, most of the insurance companies has projected again and given their views to their board, saying that the industry will degrow by 10%. So that was the view in 1 month. But after unlock, I will say that industry has actually shown quite a positive trend. And in September, the industry has posted approximately 4% of the positive growth. And out of that, the health insurance companies is growing more than 35%, because of this pandemic, and people wanted to have some insurance cover, corona coverage, and all other things has also come up. So industry has shown, and now we again started thinking that industry will end up in the entire year with approximately 10% of the growth. It means for the second half of the year, H2 of the year, the industry will grow more than 15%. So that is the expectation. So the from an industry point of view, definitely it's basically we have seen a lot of things is happening in the industry. The regulator is quite active, like RBI. Normally IRDA was not very active, but this time IRDA has actually shown their activeness from March onwards in terms of risk, in terms of benefit of the policyholder due, in terms of travel policies cancellation, travel claims, for Corona Kavach approvals. So I will say this Corona Kavach approval has given by the regulator in 24 hours. To those who have sent in the morning, they got the approval in the evening. So that type of the things which has been predicted by, which has been actually demonstrated by the regulator. So, and regulator detailing, asking for a BCP things, asking companies to give relaxations for the payment terms, giving relaxations for the renewal of the health insurance, for the continuity of their cover, and all those things everybody knows about it. We all got benefit out of it. So definitely the industry has and the regulator has seen a complete transformation. We sometimes laugh, and even if the joke has been circulated in the WhatsApp also, that who has made the India digital? It's basically a PMO office, or it's a CEO office, or the Corona. So that's the thing. So we were always thinking that whatever the digital capabilities we have, when we will be utilizing those, the digital capabilities, what all required to be built in, and apart from that, what all how to test the BCP. And this pandemic has actually made us test our BCP, and we found that we are quite above the mark, and everything is working very fine. In terms of risk, in terms of benefits for the policyholder due, regulator has come out with many things. Even if insurance industry per se has come out with this thing, And approximately, I will for a data perspective, I would like to share with everybody here that approximately 1200 crores claim has been intimated to the insurance companies till now. So this data might be of till last week of October, and from last week of October till now, there are not too much of reportings. But yes, around 1200 crores is the claim which has been reported to insurance companies related to corona disease, related to pandemic. Yes, this is a hit to the insurance industry, but yes, the other side, the benefit also been got by the insurance companies. The planned surgery, planned treatments, which we all would have thought that we will get it done in our family or somewhere, we stopped it because we were worried about visiting to the hospitals. So the claims from that sources has been reduced. So it got mitigated from there. So insurance company has not seen too much of burden of the pandemic claims. The insurance companies has got benefit of 2 months of first April and May, 2 months of lockdown on their motor claims, also OD claims. So basically own damage claims, which ranges between 60 to 75% every month, which has been reduced to, even if in the month of April it is reduced to 30%. April and May together was around 30-35% because emergency services were allowed. But post unlock, October, November, December, the claim ratio has surged like anything. It looks like that the entire India has been on the road, and 3 months of non-driving has made people to suffer a lot for the driving things, and we have found that lot of own damage claims has been reported to the companies. So entire industry has seen almost the around, even if we say that from from a last year perspective comparative to the previous year quarter 2, this year quarter 2 is almost the same, because though it was saying that it's a partially unlocked down, but in the month of October, even if the claim ratios for the motor is much higher than the last year October, so that is precisely is there. So that is something from a industry perspective. In terms of H2 things, as I already shared that H2, we expect that the industry will grow with the 12-13% for the H2, so that the overall for the year will be around 8 to 10%, max to max, not more than that. And in terms of profitability, if you have seen, most of the companies has come out with their financials for H1, and H1 profitability is really looking nice for the insurance companies. It will not be so glorified in the next half, because a lot of the business will be written in the second half, where the earnings will flow over the period of 12 months. So definitely the earnings will not flow, but the upfront cost which is required, like policy related cost or a commission for sourcing the business and all those things, will be upfront cost. So H2 profitability will not be too much, not be as greener as it was H1, but overall the industry will definitely post a profit. So that is precisely, and we have seen in a group cover also, there are a lot of SMEs business who are not taking the group cover. Because of this pandemic, their employees got benefited, and SME business has also started getting into group covers. So that's precisely related to insurance update and this thing. So anybody has anything, I can, if I know, I will definitely answer it. Otherwise, I think I tried to cover almost most of the things which we all wanted to know. Thank you. Over to Yogesh, if Yogesh is there and Yogesh wants to speak on something. Yogesh is also a veteran in the group. Hello, Manoj, Yogesh.
Hello, Yogesh.
Yeah, Yogesh.
Are you in? Can you unmute yourself?
Okay. So I think we lost Yogesh.
Okay, we have we always have an open house where members can raise queries on any professional topic. And we have an interactive session where our expert panel members can answer any question, whether financial reporting, whether sectors, whether capital markets, whether wealth creation, any issue. We had our panel has answered all the questions on the chat, but anybody would like to raise any issue on latest developments, please share before we close the session. A great work by Santosh, Yogesh, Hardik, Pramod, and all the team members. But welcome to raise any issue, whether it is DBS or LBP or moratorium or RBI circulars or NBFCs which came in today. Our panel has lots of insights and address any issue. We'll be covering latest issues every Saturday. Lots of panel members have come. Lots of group members have said they can share their practical experiences and insights, latest developments. A great show going on. Great work being done by Aditya, Anupam, Santosh, and the team. So anything can come on chat, or please put on your videos and share. So excellent, excellent work being done in this session.
Okay, so maybe since we don't have any questions, really thanks Santosh for your entire presentation. It was really good, and we actually got a lot of information related to what kind of disclosures companies are providing, and these are really opening up for a thoughtful left behinds for us. Like we can just go back, look into the financials and see what kind of informations they have come up in there. So it was really great. And in addition to that, I thank you for those wonderful service you are doing to the industry by writing those books. And sometimes it really helps when you are looking for some item and you just go buy the book and read it. So that's really good. Yeah, thanks so much for that. And thanks Pramod for your updates. Yes, Santosh, you wanted to say something?
No, I just wanted to thank you, Aditya and Manoj for the opportunity. Thank you all. Thank you for your participation.
And Santosh, do you have any blog wherein people can put questions in case they have any queries related to, so they can just raise a question to you and come back? You can come back later.
So not quite a blog, but we have this WhatsApp group. We have and Manoj is aware of that. So happy to happy to answer, try to attempt to answer any questions.
Yeah, thanks.
Yeah, it was a wonderful presentation.
Thank you so much, Dushyant.
Yeah.
Thank you so much.
And thank you, Pramod, for your update about the industry. That was also really great. And yeah, thanks everyone for participating. It's really good to have questions coming up. So hopefully we can have more interactive sessions going forward when we have other presentations. Yeah, thanks everyone.
Thank you, Aditya. Thanks for
Thank you very much.
doing a wonderful job connecting everybody and identifying the strength of everybody is also an important part which you have played. Thank you for convening it very well.
Yeah, thanks so much. Bye.
Thank you, everybody.
Yeah, Manoj and team, thanks. Very good session.
You can't say that, Dushyant sir. You are part of the team.
No, the team those who organized and also spoke, more active.
Yeah, definitely. I agree.
Yeah. Okay. Have a great day, everybody.
Yeah. Thank you, Manoj. Thank you, everybody.